Class is in session. Welcome to Finance University, the only school where the tuition is free and the degree actually pays you back. I'm your Dean of Dollars, and today we're performing a forensic audit on one of the biggest debates in investing. Should you put your money in all at once or drip it in over time? We're talking dollar cost averaging versus lump sum investing. Let's get into it. You've probably heard of dollar cost averaging, or DCA, right? For decades, it's been hailed as the champion of the people. It's the strategy your uncle swears by at Thanksgiving, the one that financial guides have called a time-tested method with seemingly magic results. It sounds safe, disciplined, almost foolproof. All right, so here's the 101 level breakdown. With DCA, you commit to investing a fixed amount, say $500, on the first of every single month into an index fund. It's automatic. If the market's flying high, your $500 buys fewer shares. If the market takes a nosedive, that same $500 buys you way more shares. See, it's a totally mechanical process, and it's designed to take all the emotion and the guesswork out of the game. Sounds great, but is it actually better? Well, that brings us to our first section. Because while the popular press was singing the praises of DCA, the, let's call them egghead academics, were in their ivory towers sharpening their pencils. And let me tell you, their take on this beloved strategy was, well, it was a lot harsher. Yeah, this wasn't some gentle critique. This was a sledgehammer. In 1993, Knight and Mandel published a paper with this absolute bombshell of a title: Nobody Gains from Dollar Cost Averaging. I mean, wow. They basically threw down the gauntlet and declared war on the entire DCA philosophy. So what was their big argument? So they started with simulations. Now, if you look at this chart, they ran thousands of possible market scenarios. These numbers represent something called certainty equivalent wealth, which is really just a fancy way of asking how much guaranteed money would you need to feel just as good as taking this risk. The higher the number, the better. And as you can see, in every single case, buy and hold, which is our lump sum investing strategy, absolutely trounced DCA. It wasn't even close. And hey, this wasn't just some theory. They went back and looked at 30 years of actual S&P 500 data. Just look at the trend here. Across every single risk profile you can imagine, from super conservative to really aggressive, the lump sum strategy just plain generated higher returns. The math was just relentless. On average, getting your money into the market sooner was simply better. And this finding has been proven over and over again. Study after study, including a massive one from Vanguard, found that lump sum investing beats dollar cost averaging about 2/3 of the time. Let that sink in. 2/3. So from a purely mathematical standpoint, if you get a big chunk of cash, the historical data is screaming at you to invest it all at once. So why? Why does lump sum win so often? Well, the villain of the story is something called cash drag. See, over the long term, markets tend to go up. That's the whole point, right? That upward slope is what we call the equity risk premium. It's the reward you get for taking the risk. When you use DCA, a chunk of your money is just sitting on the sidelines in cash, waiting its turn to get invested. That uninvested cash is literally a drag on your portfolio because it's missing out on the market's general climb upwards. Okay, let's just pause for a second. If the math is so crystal clear, then why on earth do so many smart, experienced financial pros and even legendary investors still recommend DCA? Is everybody just bad at math, or is there something that the academics are missing? Well, that brings us to the practitioner's rebuttal. Enter Burton Malkiel, the author of the investing Bible, A Random Walk Down Wall Street. He and a lot of others argue that the academics are totally focused on the wrong thing. They're obsessed with squeezing out the absolute maximum average return. But for real people, human beings, the goal isn't just about returns. It's about managing risk. And the key idea here is something called time diversification. Look, we all know about diversifying your stocks. You don't put all your eggs in one company's basket. Well, time diversification says you shouldn't put all your eggs in one day's basket either. By spreading out your purchases, you slash the risk of being that incredibly unlucky person who invests their entire life savings the day before a huge market crash. And this slide, this is where the practitioner's argument really shines. Check this out. A 2018 study looked at almost a century of data, and sure enough, over on the left, lump sum had higher average returns. No surprise there, we knew that. But look at the middle column, standard deviation. That's just a fancy term for volatility, the wild swings. LSI's volatility is almost double that of DCA. Now for the real kicker, look at the Sharpe ratio on the right. This measures your return per unit of risk you take, and here, DCA is the clear winner. It's like getting more return for your sleepless nights. And that gets us to the psychological argument, which, honestly, might be the most important one of all. For most of us, the most painful feeling in investing isn't the greed of missing out on a gain. It's the crushing weight of regret from a massive loss. DCA acts like an emotional circuit breaker. It helps you avoid that paralyzing fear of going all in at the absolute worst possible moment. So who's right? The number-crunching academics or the street-smart practitioners? You know what? The modern thinking is that they're both kind of right and they're both kind of wrong. The real answer isn't about picking a single winner for all time, but about understanding the right time and place for each strategy. Yeah, recent research has added this fascinating new layer. Some folks found that DCA's performance isn't totally random. It actually seems to have a tactical advantage. It's more likely to beat a lump sum investment when you start investing during times of really high market valuations, when stocks look expensive compared to their long-term earnings. That suggests DCA isn't just an emotional crutch. It can be a pretty savvy move to avoid buying at the top. So let's just boil this whole thing down. On the left, you've got lump sum investing. Its goal is pure, simple wealth maximization. It works by getting you exposed to that equity premium as fast as possible. It is, without a doubt, the perfect strategy for a rational spreadsheet. And on the right, you've got dollar cost averaging. Its goal is totally different. It's to minimize regret. It works by managing volatility and the risk of bad timing. It's a strategy built for the emotional human. So, the big question is, how do you choose? This is not a one-size-fits-all kind of deal. You need a way to figure out which camp you actually belong to. So for our final section, let's build a little framework so you can make an informed choice for yourself. Okay, here's a practical checklist. First, be brutally honest with yourself about your risk tolerance. Could you really watch your portfolio drop 20% and not panic sell? If the answer is no, LSI might be a tough ride. Second, take a peek at market valuations. You can look at metrics like the CAPE ratio to see if the market looks cheap or expensive right now. If it's screaming bubble, DCA starts to look a lot more attractive. Third, and this is the big one, know your own psychology. Is your fear of missing out stronger than your fear of losing money, or is it the other way around? And finally, whatever you choose, commit to it. The absolute worst strategy is the one you start and then bail on halfway through. Because ultimately, it all comes down to this one single, powerful question. Are you investing to maximize wealth, or are you investing to minimize regret? There is no right or wrong answer here. One path prioritizes the final number on a spreadsheet. The other prioritizes your ability to sleep soundly at night. Your job as an investor is to decide which one of those destinations is more important to you. And that's the bell for today, folks. If you want your financial degree to keep paying you back, make sure to smash that like button and subscribe to join the student body. To keep the lights on here at the university, check out our affiliate links in the description and the pinned comment. It's the best way to support the channel. Remember, we drop fresh knowledge every Wednesday and Saturday. Class dismissed.